how, what they do depends on the
Has everybody had a chance to read chapter 18? Is there anybody who has not yet read chapter 18? Okay. So we saw in the Mary example that a sale of shares is actually a fairly simple transaction. I mean, on her tax return, she's got proceeds minus adjusted cost base, minus capital gain deduction. And I'll grant you there's some calculations behind that, for example, the C&L account, all that kind of stuff. But it's still relatively straightforward. She's selling shares. It's one set of proceeds, one set of cost. When a corporation sells assets, what happens is the corporation is selling its business, and it's selling each individual asset. And so it's selling its accounts receivable and its cash and its inventory and its fixed assets and all the rest of it. And each one of those will have its own sort of tax transaction. So a sale of fixed assets, for example, will have recapture and capital gain and that type of thing. That's sort of the backdrop to chapter 18. So when you get into chapter 18, what you're actually looking at is a big tax calculation of the type that's in chapter 13. So if you can do chapter 13 really well, income taxed to a CCPC, chapter 18 will be a walk in the park, because all we're doing is now applying that chapter 13 knowledge to the sale of a business and the various items of income that arise from it. The thing that the textbook authors want you to know is that, and I want you to know, is that when you have a negotiation, the shareholder typically wants to sell shares and the buyer wants to buy assets. There's a tax reason and a non-tax reason for the buyer want to buy assets. The non-tax reason is they don't want to assume the liabilities of the company if they can help it, especially if the company has bad history where maybe there's some lawsuits coming that they don't even know about and stuff. So if the buyer buys the shares, the buyer inherits all of that bad stuff, skeletons in the closet. That's the non-tax reason why a buyer prefers to buy just the assets. The tax reason is that if the buyer buys the assets, it gets to claim capital cost allowance, for example, on the fair market value, which they paid for the assets. So for example, if they're buying a building, if the building is worth twice as much as the original cost, the buyer now gets to depreciate the building, claim capital cost allowance based on its today fair market value, which is high. If they buy the shares, well, the company just continues to claim capital cost allowance based on whatever its UCC is. And after a lot of years of capital cost allowance, the UCC might be a pretty small number. So there's this tug of war because the buyer wants to buy assets, the seller wants to sell shares because the seller wants to get capital gain treatment, which is only 50% taxable, as opposed to keeping the company and then having the company pay tax and recapture and all kinds of stuff like that. Plus the seller might be able to get the capital gain exemption, which is even better. The seller might end up paying very little tax if they sell shares, but their company and then they will pay a lot of tax if they sell assets. So often the way a negotiation goes is somebody says to me, I want to buy your business. And I say, okay, well, how much do you think it's worth? And they say, well, I think it's worth $10 million. Then I go back and check with my accountant and say, if I get paid $10 million for this business, that is, if my company sells the assets for $10 million, how much is that in my pocket after taxes? So the accountant goes away and comes back with, okay, well, if we break down the $10 million by fair market value, there's, well, your building is worth this much, and your other fixed assets is worth this much, and then there's going to be some goodwill. So if we sell the building, there will be recapture and capital gain. If we sell the other fixed assets, there will be recapture, capital gain. There will be goodwill gains, etc. So you'll pay tax on all of that. You might get some small business deduction, good. You might have to pay some refundable tax on the capital gains, taxable capital gains. all that sort of $10 million of proceeds minus the tax, minus paying back the liabilities to whoever you owe money to, is how much that's left in my pocket. I say, okay, well, let's say for sake of discussion that's $4 million. I prefer to sell shares. I will go back to this purchaser and say, rather than pay me $10 million for my shares, for my assets, pay me this much for my shares. That'll give me the same amount after tax, which is $4 million. It is possible to work backwards from the $4 million to what the share purchase price should be. And the formula is in the textbook. It's on page 657. No, this isn't crazy math or anything like that. This is like pretty straightforward algebra. And I like the way how they've set it out here so you can sort of understand if you're starting with a net proceeds from what they call the worst case scenario, and the worst case scenario is always selling assets. I will always end up paying more tax on an asset sale than on a share sale. It's almost guaranteed. So you start with the asset sale. That's the worst case, and that results in the lowest net proceeds. So the prospective purchaser said, I'll pay you $10 million for the assets, and after I did all the taxes and repaid all my liabilities, that's $4 million. So now I use this formula and work backwards. This is on an asset sale. This is a share sale. And it's possible to work backwards from $4 million using this formula, and there's a place in there where I put my adjusted cost base and stuff like that. And that might come up to, say, a $6.2 million share proceeds after paying tax equals the same $4 million after tax as with the asset sale. Now I've got something I can go back to the purchaser and sort of negotiate. Well, I really prefer to buy shares. 6.2 is the equivalent of 10 million. How does that sit with you? Well, they come back with, well, we'll give you 5.5. And I say, no, that's a little bit too low. Can you give me 9.8 for the assets? And that's actually how it goes. And this person is thinking about their capital cost allowance position and stuff like that going forward. And this person is thinking about their tax position and the fact that they'll pay less tax on a capital gain. And at the end of the day, they might end up with this deal or with this deal, but at least both of them sort of understand how the other one thinks, and this one has a good accountant to figure out both the 4 million after tax here and then working backwards with the 6.2 is the equivalent share purchase. That is chapter 18. Yes?
I have two questions. The first one is, if a business has generated goodwill, that goodwill is actually attached to the business as a whole. So how can you actually parcel out the goodwill? Like on its own as an asset, isn't it worthless? If you give away all the assets individually, even though you're giving them to the same company?
So the question is, on an asset sale, is the goodwill worthless? Presumably it is, because you're selling the individual assets, right?
Yeah, that's kind of what I'm thinking. You know, like people go to McDonald's because McDonald's has built a brand name, right? So they have a certain amount of goodwill that they've generated or created. If they actually took and sold all of their buildings and stuff and they're no longer at McDonald's, isn't their goodwill dissipated?
They're not just selling the buildings though, they're selling the entire business.
But on an asset sale, they're not selling business.
They're even selling the name too, though, aren't they? But
We're selling everything, we're selling the name and the customer lists and the McDonald's recipes
Oh, so
and
it's sort of attached to pieces.
Ronald and the Golden Arches.
Okay, okay.
So
Okay.
it's actually the entire business that we're selling. It's just that we have to figure out the tax on the gain or loss on each individual component of it.
Oh, okay.
But it is the entire business we're selling, hence why we have goodwill.
Oh, okay.
Second question.
The second question is, didn't you say that the asset side of that is the worst case scenario?
The asset side of this is the worst case scenario.
So then isn't the implication that the seller would not take a price lower than that?
It is
So.
lower than
Than the
this
10
or than
the-
this?
and the 10 and the 6.2, so you've got examples there where they've both gone down, but if that's the worst case scenario, wouldn't the realistic answer be that unless they're desperate to sell for some reason, that they wouldn't take a price below that?
Well, let's say that this is the opening offer. By worst case scenario, what is meant is that for every dollar of proceeds, in this example, we're going to be paying 60% by way of taxes and repayment of liabilities goes out the door, and all we're left with is 40%.
Oh, so worst case indicates the most tax that we could possibly pay.
Precisely.
Thank you.
And that's guaranteed to be on the asset side.
Okay,
Just because you've got like recapture and stuff that's fully taxable, as
Okay.
compared to capital gain, which is always only half taxable.
thank you.
Now, when you get to KC 18.2, 18-2, I posted a supplemental question to D2L. Did anybody have a chance to look at the question yet? Okay, well, of course. I also posted the answer.
Besides me?
So the supplemental question was on a sale of a business. And in fact, let's just turn there quickly. So it's on page 670. So essentially, it's a large. It's a large.
No, that's not the question. It's on 668, isn't it? KC2?
I beg your pardon. Yeah, you're right. So we sold all these assets, and on each one there's a tax gain or loss, and there's CCPC tax to pay, and there's dividend refunds and all that kind of stuff from Chapter 13. And at the end of it, we get to know the amount available for distribution to the shareholders. And in fact, that's the one that I put on the screen earlier. It's that one. And I liked it a lot, and I thought, what if we applied this formula to figure out what the share purchase price might be? So that's the supplemental question. So once you've done the actual question in the book here, that takes you down to this number. And then working backwards from this, using that formula takes you up to this number, or whatever the equivalent number is based on these facts. So just give me a heads up for how it works, and I hope you'll do that question. There's actually nothing else to say about Chapter 18. All it's about is applying the Chapter 13 principles to the sale of a business and calculating all of this and then calculating that. And all you need to know is these mechanics and why a purchaser prefers to buy assets and why a seller prefers to sell shares. Both the tax reasons and the non-tax reasons. On the seller selling shares, actually, I can only think of a tax reason, and it's to get lower taxes. I can't think of a non-tax reason to sell shares.
Well, wouldn't it give them less responsibility because they wouldn't have to worry about dispersing the liabilities and so forth? Maybe?
Not a
No?
deal breaker, no. I just want to scroll back for one small issue on chapter 13. It's in the review questions. And it's review question 7. Did anybody do this question? Do you know the answer?
Didn't you talk about this last time?
Did I?
Yeah. I believe you did.
Good, then what's the answer?
You said that if a corporation gets income from another corporation that was active business income, there's some lovely part in the act.
That was deductible against active business income.
Yes, that was deductible as active business, but is it interest, or sorry,
Sid?
normally SIB income to the other, because it came from an active business income source in the other company.
Right.
It is now active business income,
If they're associated.
if they're associated.
Good, I did, thank you, sorry.
Apparently I wasn't listening. No.
You will also see, when you do chapter 18, that Cindy put together a spreadsheet covering the Mary example from the assignment. So if the Mary example was a sale of assets, how would it look? So just to give you apples to apples on a situation that you already are very intimate with, you'll be able to see what that looks like. So hopefully the combination of that KC 18.2 reboot showing working backwards from net asset proceeds to share purchase price, and then the Mary example as an asset sale will show you both sides of the sale of shares and assets. Chapter 14. I don't think there's anything left for us to discuss there unless anybody's got any questions. Is everybody okay in the use of holding companies? Any questions on that?
Do we need to know how to do some calculations with that?
No, that's just about principle. The only calculations are about when I have a sale and I want to pay a safe dividend. Remember that one? That's a calculation. So that's the one where I set up a holding company just before selling my operating company. And I pay a dividend up to the amount of retained earnings.
Oh, yes.
Also called my safe income?
I forgot that's what it was called.
That's a calculation situation. The others are just about under what circumstances would I set up a holding company.
Oh, okay.
So one was
it's more-
creditor proofing, one was if I had two different shareholders that had different
Consumption.
consumption versus investment. Acquisition, so you recall I set up a holding company that had an amalgamation. And finally the divestiture one.
Oh, okay.
Is there calculations with the buffer?
Um,
Or is it concept?
More just the concept, to know that I'm able to step up what we call the inside basis, my adjusted cost base of, say, my land, up to the amount of the fair market value of my shares, if, say, my land represented the full fair market value of the company when I bought it, just like that.
Okay, so just know the rules.
Just know the rule.
Okay. Okay.
chapter 15.
We have a lot of time left to review them.
Page 590. So partnership is not itself a taxpayer. You may recall from chapter 3 that taxpayers are individuals, corporations, trusts, etc., but a partnership is not one of those. What a partnership is when, and usually a partnership we use this shape, so you'll know if I draw one of these, it's a diamond shreddy, not a square
That's the
shreddy.
square one.
So here's a partnership of an individual and a corporation, and let's say it's 50-50.
A partnership of a corporation?
Yeah, so a corporation is one of the partners,
That really exists?
daily.
Hmm.
So any type of entity can be a partner, an individual can be a partner, a corporation can be a partner,
Thank you.
a partnership can be a partner.
Okay.
And then all that happens here is that a partnership is two or more parties coming together to operate a business on a long-term basis. And we have choices. We can operate a business as a sole proprietorship or as a corporation or as a partnership. Partnership's not a taxpayer, but we do calculate net income at the partnership level. So what that means is if it's operating a business and say there's capital cost allowance and stuff, that gets calculated at the partnership level, deducted to come up with the net income of the partnership, and then that gets allocated 50-50. So it's like it actually does a tax return to come down to net income, but it doesn't pay income itself. It tells these people how much their share of income is.
So could, if they both set up corporations, could that be like a form of liability protection?
Yes, it would. Yeah. This person is exposed to whatever the bad things are in this partnership.
Can you repeat that question?
Question is, if a corporation is a partner of a partnership, does that provide any limited liability protection
To who?
to this person who's not a corporation, to a partner?
Where was the corporation in that question?
If this person had a corporation,
Yes?
would they get any limited liability protection thereby? And the
Oh.
answer is yes. So for example, if they set up a corporation,
Like the guy on the right?
like the guy on the right, they would now have protection that they don't have.
Oh, they don't have that in the left situation, but
No.
they do in the right,
Correct, because a partnership doesn't afford any limited liability protection,
unless it's a limited liability partnership,
which is
not this
in about
case.
half an hour.
Okay. Thank you.
So we calculate income at the partnership level and then split it 50-50 or 30-70, whatever the partnership percentages are.
And how do they report that income? As business income?
As whatever type of income is earned by the partnership. So if the partnership earns business income, it's business income. If it's interest income, it's interest income. If it's dividends, it's dividends.
Oh, okay. So sorry. Is there some formal document that CRA requires for tracking?
As you might expect, there's a form to fill out that looks like a tax return but of the partnership.
Thank you.
Next important thing is the timing. So I'm going to draw you a little timeline here. This particular partnership, and a partnership has a fiscal year end just like a corporation has, but this particular partnership has a December year end. So it has a partnership year that runs from January 1st, 2012 to December 31st, 2012. 12 months. One of the partners is a corporation. The corporation's year end is November 30th. So in this particular calendar year, it'll be November 30th, 2012. So its taxation year goes back to here. You okay with that? I should have used different colors, but the question is, this corporation, let's say it's a 50% partner in the partnership. For what taxation year of the partnership does it report in its corporate tax return? And the answer is, whichever year end of the partnership ended within the corporation's year end. This year end, December 31st, 2011, ended within the corporation's taxation year ending November 30th, 2012. So in this case, this corporation will always be sort of 11 months behind.
But they include the entire year for the partnership?
Yes, the entire year of the partnership that ended December 31st, 2011 and started January 1st, 2011. The corporation likes this a lot because if the partnership is profitable, the corporation is always paying tax 11 months later. In fact, a lot of people who have corporations and go into partnerships purposely set the partnership year end a month after to give this exact deferral we speak of. And the deferral comes because the corporation picks up the partnership taxable income for the partnership fiscal year end that ends within the corporation's fiscal year end. And thereby there can be up to an 11-month or actually a 364-day deferral depending on what the partnership taxation year end is. I'll stop there. Any questions? Yes?
Can you do that with multiple partnerships and stuff?
We used to be able to, and now the CRA has said that's either garable or they'll find some other way to.
When did that go into place? Just,
I'm going to say about 10 years ago.
oh, okay.
I myself, there's a rule that they call that a stacking rule.
Mhm.
So like you can have 6 partnerships and 8 deferrals, and there actually was a rule like that for individuals.
Oh.
I was once a member of a partnership. We had a 23-month deferral. And they brought in a special rule that said for individuals you can no longer do that. And to catch us up, it was such a big deferral that they caught us up over 5 years. Otherwise people would have gone bankrupt. People like me would have gone bankrupt just having to pay the tax that had been left unpaid for 23 months. So typically one level of deferral like this is okay, but Revenue Canada is not good on two levels of deferral. Yes?
I think you answered it, but you said the month is arbitrary, could be the day after, or?
Could be the day after, but usually they're done at month end to allow accountants to do their cutoff more easily. So 11 months is quite common. 364 days is theoretically possible, but not common. So that's the timing.
Are you going to show us for a person that owns a partnership?
A person that owns a partnership, person automatically has a December 31st year end.
Yep.
So in this particular case, an individual would be reporting on the same basis as the partnership.
So they might want to change the partnership year end? Like, are the rules the same? So if you change the partnership year end and yours is fixed at December 31?
If the partnership had, say, a January year end, which would provide
Yeah.
a benefit in that case.
You,
No, I'll tell you why. So I was a member of a partnership that had 500 partners. The fiscal year end was June 30th, and they always ran a fake year end at December 31st to get us the December 31st numbers. Because do you remember in chapter 5, I think, there were
Oh.
examples of business income earned by an individual,
yeah,
where even if you set your fiscal year end off
Yeah.
December,
yeah,
the same thing applies with a partnership if you're an individual.
thank you.
I'm more interested that you learn the corporate side of this,
Oh,
not the
you want me to
individual
go?
side. You're just
Oh.
only needing to know that for a corporation pays tax based on the partnership's fiscal year that ends within the corporate year. Partnership interest. So if I own part of a corporation, I own a share. If I own part of a partnership, we say that I own a partnership interest. Partnership interest, let's say that at December 31st, 2011, I had just put in $50,000 into a partnership. On my personal general ledger, my journal entry is debit partnership interest, credit cash. And we say that the adjusted cost base now of my partnership interest is $50,000. In 2012, my share of the income earned by the partnership is $110,000. That gets added to my partnership interest adjusted cost base.
So that 50,000 is your adjusted cost base?
Yep. And it just got added to by 110,000. Yes?
Sorry, I didn't hear you, is that 110 earned throughout 2012 or?
110 is my share of the partnership earnings for the 2012 partnership year. And I took some money out of the partnership. I drew money out, I had a draw. I drew out 125,000. My end of year 2012 partnership adjusted cost base. Anybody do the math?
35,000.
So this is different from a corporation. The adjusted cost base of my corporation share would have just been $50,000. And if I put in money or whatever, that doesn't affect the adjusted cost base of a corporation share. But all these transactions affect my partnership adjusted cost base. This is a good thing. Because let's say that I sell my partnership interest now for $35,000. I have no gain or loss. My proceeds is 35, my adjusted cost base is 35. I have already paid tax on this income. This goes into my tax return. It's my share of earnings from the partnership. So the tax system allows me to sort of take credit for it. I get to add it to my adjusted cost base. If I didn't get to add this to my adjusted cost base, it would cause me a capital gain when I sold the partnership because my partnership interest would not have been increased by 110,000. So I get credit for this 110 that I'm paying tax on. They take away from me, and so they should, adjusted cost base for what I take out of the partnership. And at the end of the day, if I sell this for 35, which actually is my share of sort of the retained earnings and what I put in. In fact, I guess net, I have put in 50,000 and taken out sort of 15. So my share of the book equity really is $35,000 only. If, say, the partnership had some goodwill attached to it and I sell my partnership interest for $200,000, then it's my capital gain is 200 minus 35. Yes?
If the $50,000 that you put in was obviously after-tax money,
Correct.
I assume the $35,000 that you take out is also tax-free because it's actually the same money you've already.
Well, the 125 that I took out comes out to me tax-free because I'm just getting some of my own money back.
And the 110 that you're paying tax on is not actually money in your pocket. It's just accrued income.
Very good.
So you're paying tax as you go along on money that you're not actually seeing unless you draw it out. But when you draw it out, it's tax-free.
It's
Because
the
you've paid money on, you've already paid tax on it. It's after tax.
That's right.
earnings. And same with the 35,000, so if you sold it for the remainder of your ACV, that would be a tax-free.
Correct. Or if I took out the 35,000, that would also be tax-free.
So either way.
So either way. So this is the opposite of a corporation. Corporation, I only pay tax, I don't pay tax on the corporate earnings, I only pay tax on dividends, like when they actually pay me something. Partnership interest, I pay tax on my earnings whether or not I take out any money. But if I do take out money, all it does is reduce my adjusted cost base. This is not a taxable amount to me. Only my share of income or loss shows up on my tax return. It's the exact mirror opposite of a corporation. Yes?
So by changing the ACB, like pretty much when these transactions happen, is it kind of like you're doing a mark to market constantly? Like,
Not really, because mark to market would be how much is this actually worth?
okay.
What it is doing a running total whereby every transaction I have with the partnership might affect my adjusted cost base, putting money in, taking money out, and my share of earnings. Yes?
So in practice, does this cause any hardship with the difference between when you have to pay tax on money that you don't have and when you are able to draw money out? Because, you know, generally speaking, businesses need money to function, so that the business as a partnership may not wish you to take out the money that you've earned and paid tax on. So is there a disconnect between necessarily paying the tax and getting to take your money?
Yes. If say my partnership earns, or my share is $100,000, 110, and let's say the tax on that is 40,000. So this is tax that I actually have to pay.
Which ideally you'd like to get the money out of the company to pay that, right?
Partnership.
But, sorry, partnership.
If the partnership is strapped for cash or something and can't pay me the 40,000, I have to go to the bank and borrow money to pay my taxes. Because I'm taxed on this whether or not I take the money out of the partnership, or whether the partnership even has money to pay me.
I don't suppose that's deductible as a business expense either. I was just kidding, I know it's not. Just kidding.
Please turn to page 595. Now, I might be running a proprietorship.
What page?
595.
Thank you.
And I might have met someone with whom I'd like to do business as a partner. And I have business assets that I'd like to put into the partnership. And so does the other person. If this were a corporation, how would we do this?
Section 85 rollover?
We'd have a Section 85 rollover. And would you please turn to Section 97? (97) bracket 2. So basically what this says in the preamble is when one or more people dispose of property, so transfer property, sell property to a partnership, the provisions of Section 85 apply as if it were a corporation. Which is awesome. That means that we get rollover treatment. And the adjusted cost base of our partnership interest gets set at the elected value. So it's just like a Section 85 rollover, there's an elected value, and our partnership interest ACB gets increased by the elected value. And again, we normally elect at tax values. And if there's non-share consideration, hopefully there is, we can take out non-share consideration equal to that amount. Tax deferral, just like Section 85.
So the share consideration is the partnership interest?
The share consideration is the partnership interest. Page 596. Two individuals get together and they say, let's do business together. And they like the idea of having corporations. The business is probably going to do $600,000 a year in active business income. And they say, well, we know that if we set up a partnership, we know that if it's 50-50, we get allocated the partnership income to us 50-50, and it retains its character. So if it's active business income to the partnership, it's active business income to the corporations, $300,000 apiece. And they say this is excellent or better than excellent because each of them can claim up to $500,000 small business deduction, right? And 300 is less than 500, so it's all good. There's a rule that says the most that they're allowed to claim small business deduction coming out of here is $250 apiece for a total of 500.
Oh, is that somewhat like because they're sort of associated?
It's like they kind of tried to get around the association rules or something. And this says no. So this company can claim small business deduction on $250, and then the other $50,000 is general rate income, and the same here.
And that's because they're a partnership?
Only because they're a partnership.
Okay.
And there's just a rule that says when we allocate this income, we also have to allocate the $500,000 limit. There's only one $500,000 limit in here, and it gets allocated the same as if we were associated.
So if there were 5 corporations sharing that partnership, they'd each only be able to claim 100,000.
Correct. That's it for chapter 15. Chapter 16. By the way, we're into the easy part of the course now, and I mean it. Like this is a cakewalk compared to like chapter. You get chapter 13 and chapter 18. You're good. This stuff is. I mean, if you want to come to class on Thursday and Tuesday and do chapter 13 and 18 questions while I'm lecturing, I won't be offended.
Are you going to answer our questions during your lecture?
Well, I might. In fact, on Tuesday, I want Tuesday to be a heavy chapter 13 and 18 day. That's our review session day.
Okay.
But honest to God, on Thursday, if you want to just listen to me with one ear talk about trusts or whatever, fine, and do all the questions on chapter 13 and 18, I'll be pleased. Limited partnership.
What chapter are we on? 16?
Got to keep up.
Jeepers. What a rough weekend. Come on. Oh, yeah.
So limited partnership answers the question, how can we get limited liability protection?
Those lawyers.
A partner of a limited partnership can get limited liability protection as long as they're not actively involved. So if they're just sort of investing money and it's a passive thing, they're hoping to get a return, but they're not part of the management team or anything like that, they will get limited liability protection. The usual investors in a limited partnership are individuals. So these are limited partners. That means that their exposure, let's call it, is only up to how much they put in. So if they put in $50,000 as their investment into the limited partnership, that's all they would lose if things went badly. There needs to be one general partner. This is just the law of partnerships. There needs to be one general partner. And usually that's a corporation. And usually this corporation only owns about 1%. So this is the entity that's actually on the hook if this thing loses big. And since it's a corporation, it makes this person who's the shareholder of this corporation really happy because this person has limited liability protection. And the corporation only has a 1% interest. So all of these people would have a 99% interest. The reason for this is as follows. Most limited partnerships are set up designed to lose money, at least in the first couple of years. They typically always have startup losses of some kind. They actually lose money, or they've got giant tax deductions or something like oil and gas deductions or what have you, that cause a net loss for tax purposes. Well, these are partners, and as you know from the previous chapter, the income or loss is measured at the partnership level, and it gets allocated out to the partners. And if it's a loss that these people get allocated, which means they can claim a loss in their tax return. And a common thing is that someone will invest $50,000, let's say, and the business plan is that there will actually be $50,000 worth of deductions going back to them over the first 2 years. If they're in, say, a 40% tax bracket, that reduces their taxes by 40% of $50,000, 20 grand. So their net cost of the investment is really only $30,000, which is the 50 they put in, minus their tax savings over the next couple of years. And that's exactly how limited partnership investments are marketed, are sold. Yes?
Can you give us an example of one of these types of companies?
Yes. Real estate companies that are expecting large capital cost allowance deductions. And they can't claim CC to increase a loss, but they already have large losses from interest expense, especially at the beginning when the mortgage amortization is low principal, high interest. So the net income for tax purposes from the real estate investment in here is a net loss, and these people get to claim the net loss.
So are you implying then that once that, I mean, nobody operates, okay, in my opinion, nobody would operate a company to forever generate losses. Like,
No.
eventually they would expect to have a profit and then they would want to change this structure?
Eventually they want to have a profit, and these people want to have a profit. But they're very happy if in the meantime they can get
They
tax
get the losses.
losses to deduct in their tax return.
Oh, okay, okay.
Now, in our example, each of these people put in $50,000. We call that their at-risk amount. For good reason, it's the amount that they've got at risk. But that's also a tax thing, and they are not allowed to claim cumulative deductions more than what they put in, more than the $50,000. So that if this thing throws off $60,000 worth of loss apiece, they are only allowed to claim $50,000. So an amount equal to their at-risk amount.
Per year?
Cumulative, forever.
Oh, forever?
Yeah. The at-risk amount is discussed on page 615. Two-thirds down the page, bullet 3, in a limited partnership, the use of tax losses allocated to the passive limited partners is restricted to a maximum of the at-risk amount. Cumulative, it's not per year, it's cumulative. Whereas all partners in a standard partnership can use the full amount of losses allocated. On page 616, gives you an example of buying a limited partnership interest. I get to have losses allocated out to me, and that reduces my investment. So if I had expected to put in $10,000, I get a tax savings. Therefore, my net cost is only $8,200. Joint ventures, page 623.
We can cross out the other stuff.
You can cross out the stuff that I told you to cross out in the email I sent earlier.
Thank you.
And I think it's on D2L
Yep,
as well.
it is.
So a partnership is two or more parties getting together to carry on business. And generally speaking, they're probably going to have a long-term relationship, and that relationship might also include other things that they might do over time. A joint venture is something else. A joint venture is with respect to one activity. The earliest joint ventures, as I understand it, were merchants that would, say, hire a ship and travel from Great Britain to the Far East and buy stuff in the Far East and bring it back to Great Britain. And that would be a joint venture. That trip with those people that I chose to do business with on that day, that's a joint venture. When the ship gets back, we all take our stuff off. We may or may not ever see each other again. We're not carrying business on a continuous basis going into the future. So that gives you some idea of what a joint venture is. It is a lot less formal than a partnership. A partnership agreement is typically a big document that is going to last a long time, so it talks about how the partners shall act with each other and how they'll do business with the partnership. A joint venture is, hey, let's charter this boat, or let's build this building or something, and then we'll probably sell it off in 2 years and do something else. So these joint ventures are popular with people like real estate developers because it's sort of a project-based type of thing. The difference between a joint venture and a partnership is as follows. I don't know what shape to use. Give me a shape to use.
A flower.
A pentagram. With a partnership, we calculate net income at the partnership level. So the capital cost allowance and all that kind of stuff is determined at the partnership level, and then my net income is, I get informed of what it is, whatever my percentage is. With the joint venture, the assets of the joint venture actually go on my tax return. So for example, if it's got Class 8 assets, I claim capital cost allowance on my share of those Class 8 assets. Or I don't claim it if I don't want to. I've got the flexibility to determine my own net income arising from the partnership. For example, with respect to discretionary deductions, I need not calculate them. Partnership is different. If a partnership decides that they're going to claim CCA, they're going to claim CCA. That may not be good for me. Or they might decide not to claim CCA, and that may not be good for me. So I don't have control, but with a joint venture, I've got control. I think in accounting terms, it's like proportionate consolidation. I don't know if that's a accounting term that's still used, but it's like I take my share of whatever on here and put it on my tax return. Yes?
Just a couple questions about that. So if you have a Class 8 asset and you're claiming CCA, can the other entity that you went into this joint venture also claim the CCA on that asset?
Yes. So what happened, let's say that this is 3070, and the Class 8 asset, the UCC or the original cost, let's say, is 100. I put $30,000 as an addition on my tax return, on my CCA schedule, and this person put 70, and they can claim or not claim every year, and I can claim or not claim every year.
What about in a situation where if you went into a joint venture with somebody and you brought certain assets to the joint venture with you? Like, for example, if you're going into the joint venture because you have expertise and the other person had an expertise in something different, but together you were gonna use both your expertises, and you brought that Class 8 with you, would that other person still be able to claim CCA on that, or?
Good question. So in this case, I brought in the asset and they brought in the expertise, let's say. With a partnership, that asset would probably go in the partnership. With the joint venture, I don't actually have to put that asset into the joint venture. That means that I would claim all the capital cost allowance on it.
Okay.
But that's a deal, a side deal that I negotiated with my joint venture partner, where they're going to contribute something else. I must really trust them that their expertise must have value, because I'm putting this asset in and I know what this asset is worth. But if I do trust them like that and I just sort of put in my asset, I'll claim capital cost allowance on all of it.
So you have the option of putting in the asset or not?
That's negotiated between
Oh, yeah,
the
on
joint.
side, yeah.
Yeah.
Okay.
But the typical case is that the asset is an asset of the joint venture. Probably what happened is I actually put money into this, and so did this person, and then collectively we bought an asset. That's normally what happens. And then I get to have my share of that and claim CCA on it, and so does the other person. The other thing about a joint venture is this year ends we talked about with a partnership. There's nothing like that with a joint venture. If my corporate year end, let's say my company is a joint venturer, if my corporate year end is November 30th, I report all of the joint venture's profits to November 30th. So there's none of this deferral stuff like we saw is possible with a partnership.
You're saying you would claim the proportionate amount of the income?
Yes.
Okay.
In fact, what goes on my tax return with a partnership, I'm sorry if I sound repetitive, we calculate net income in the partnership, and that's what I get my share of. With the joint venture, probably what I'm being reported to me is my sales, my cost of sales, et cetera, and I'm reporting all of that stuff on my corporation tax return, and then I claim capital cost allowance if I want against that.
But you've got a circle there, and you just said you'd claim it as a corporation. Do you have to have the corporation there? So if you are an individual, would you still claim it that way?
Claim what way?
Well, the sales minus the cost of goods.
Yep.
Okay. Thank you. As business income, right?
Usually joint ventures earn business income, but it's like a partnership in that whatever type of income is being earned,
Okay.
it shows up here.
Okay.
It's just that I get to control the discretionary deductions
Mm.
as a joint venturer, which I do not if I'm a partner. There's no such thing as a joint venture interest. So there's no requirement to track this or that. What there is the adjusted cost base of my share of all the assets. So the adjusted cost base for the UCC. So that, for example, if the joint venture assets get sold, I get my share of the proceeds and I deduct against that ACB, et cetera, to figure out what my recapture is. And finally, this small business deduction limitation I mentioned for a partnership doesn't apply to a joint venture. So I simply take my share of income minus my discretionary deductions, and I might get up to $500,000, and so does my joint venture partner. Now, you might think this causes a big rush to enter into joint ventures rather than partnerships because we're getting around something. Actually, joint ventures are pretty rare, and there's no sort of tax reason to get into one as opposed to a partnership, except that some people very much like this flexibility deal where they get to claim their own discretionary deductions.
Is there some advantage to that, claiming a deduction?
Yes, if I have losses that are about to drop off, or if I think
Oh.
tax rates are going to go down, remember all those
Mm, yeah,
reasons
yeah.
to...
Yep.
yeah. Yes?
The small business deduction, it's not like 500 for each sort of not 500 for each part of it. Like, it's not like the partnership, you get 500,000 and the JV you get 500,000. It's total for you as the taxpayer.
Bottom of page 624. So remember what I said about a partnership, that the corporate partners have to share 500? Under a joint venture, this limitation doesn't apply. A joint venture corporation is entitled to use the full $500,000 small business limit.
So if someone had a partnership and a joint venture, they could use their portion of the small business deduction from the partnership and the full small business from the joint venture.
Keep reading. Provided it has not been used for other sources of business income.
Okay.
There's only one chapter left.
Oh, it says that they have to be a CCPC. Well, that makes sense, because that's the only people that can train it, right?
Yeah.
Is it a hard chapter or like another fun one?
It's another fun one.
Wow, we're starting to talk like you. Chapters.
See you on Thursday. Do a lot of chapter 13 and chapter 18 questions.
Josh? Wow, that was fast.
I now have to go to my art student council meeting. I have to come on his life.